Listen up, investors. Whether you're a seasoned pro or just starting out, understanding financial metrics is crucial. Wall Street can feel like a jungle, a chaotic place where only the fittest survive. It's full of confusing jargon and complex numbers that can easily overwhelm anyone. But don't sweat it. I'm here to guide you through this maze of information. Think of financial metrics as your compass and map, essential tools to help you find your way. They help you navigate the market and make smart, informed decisions that can lead to financial success. These metrics unlock vital information about companies, revealing their true financial health and potential. They tell you if a company is a screaming buy or a total dud, helping you avoid costly mistakes. One such metric is the price-to-book ratio, or P/B ratio for short. It's a powerful tool in your investing arsenal. This bad boy can be your secret weapon, giving you insights that others might miss. It helps you find undervalued companies ripe for the picking. Remember, knowledge is power. The more you know, the better your investment decisions will be. Understanding these metrics gives you an edge in the investing game, setting you apart from the crowd. So, buckle up and let's dive into the exciting world of the P/B ratio. It's time to take your investing skills to the next level. We'll break it down in plain English so you can start using it like a pro. No more confusion, just clear, actionable insights. Get ready to make some serious money. With the right knowledge and tools, the sky's the limit for your financial success. The P/B ratio is like a price tag for a company's assets. It stands for price-to-book ratio and is a crucial metric in the world of investing. It tells you how much investors are willing to pay for every dollar of a company's net worth. Essentially, it helps you understand the market's perception of the company's value. Think of it like this. You're buying a used car. You wouldn't just look at the price tag and make a decision, right? The car's value on paper is its book value. This is similar to a company's book value, which is the net asset value of the company. But you might pay more or less depending on its condition, right? If the car is in excellent condition, you might be willing to pay a bit more. The P/B ratio works the same way. It compares a company's stock price to its book value per share, giving you an idea of whether the stock is overvalued or undervalued. It compares a company's stock price to its book value per share. This ratio can be particularly useful when evaluating companies in industries where assets are a significant part of the business. A high P/B ratio means investors are optimistic about the company's future. They believe the company will generate high returns on its assets. They're willing to pay a premium. This often happens with companies that have strong growth prospects or a competitive advantage in their industry. A low P/B ratio suggests the opposite. It indicates that investors are cautious and may have concerns about the company's future profitability. Investors are cautious and want a bargain. They might see the company as a potential turnaround story or a value investment. Remember, the P/B ratio is just one piece of the puzzle. It's important to consider other factors like the company's earnings, growth potential, and industry conditions. It's not a magic bullet. No single metric can give you a complete picture of a company's financial health. But it's a powerful tool to have in your investing arsenal. When used in conjunction with other metrics, the P/B ratio can help you make more informed investment decisions. Calculating the P/B ratio is easier than you think. Don't let the fancy name fool you. First, you need the company's stock price. This is easy to find online. Second, you need the company's book value per share. You can find this on their financial statements. Here's the formula. P/B ratio equals market price per share divided by book value per share. Let's say company XYZ is trading at $50 per share. Its book value per share is $25. The P/B ratio would be 50 divided by 25 equals 2. See? Not so complicated. Now let's explore what different P/B ratios mean for you. Stay tuned. So you've calculated the P/B ratio. Now what? Understanding the price-to-book ratio is crucial for making informed investment decisions. But what does this number really tell you about a company? What does the number tell you? The P/B ratio compares a company's market value to its book value, giving you insight into how the market perceives the company's worth. A P/B ratio of 1 means the market values the company at its book value. This indicates that the market believes the company's assets are worth exactly what the balance sheet says. A ratio above 1 suggests the market is optimistic. Investors are willing to pay more than the book value. indicating confidence in the company's future growth and profitability. Investors are willing to pay a premium for the company's potential. This often happens with companies that have strong growth prospects, innovative products, or a competitive edge in their industry. A ratio below 1 means the market is less enthusiastic. This could be due to various reasons such as poor financial performance, industry downturns, or other perceived risks. Investors see it as undervalued or risky. Remember, context is key. A low PB ratio might indicate a bargain, but it could also signal underlying problems. A high PB ratio isn't always good. It could mean the company is overvalued and the stock price might be inflated due to market hype or speculation. It could mean the company is overvalued. In such cases, the stock price might be at risk of a correction, leading to potential losses for investors. A low PB ratio isn't always bad. It could mean the company is a hidden gem, offering a great investment opportunity if the market has overlooked its true potential. It could mean the company is a hidden gem. Thorough research and analysis can help you uncover these opportunities and make profitable investments. Always consider other factors before making investment decisions. Look at the company's overall financial health, industry trends, and economic conditions. The PB ratio is just one piece of the puzzle. Combining it with other financial metrics like the PE ratio, debt levels, and cash flow can give you a more comprehensive view. But it's a valuable tool to help you understand market sentiment. By interpreting the PB ratio correctly, you can make more informed and strategic investment choices. Section 5, Industry Insights, where the PB ratio shines. The PB ratio is particularly useful for certain industries. It's a great tool for valuing companies with significant tangible assets. Think banks, real estate companies, and manufacturing giants. These companies have assets you can easily value, like buildings and equipment. The PB ratio is less reliable for companies with mostly intangible assets. Think tech companies or software developers. Their value lies in their ideas and intellectual property, which are harder to quantify. Remember, the PB ratio is just one tool in your investing toolbox. Use it wisely, and it can help you uncover hidden opportunities in the market. Section 6, Beyond the Numbers, the PB ratio's blind spots. Like any financial metric, the PB ratio has its limitations. It's not a perfect measure. One limitation is that it relies on historical data. The book value reflects the past, not the future. It doesn't account for a company's growth potential or future earnings. Another limitation is that it doesn't consider debt. A company with a lot of debt may have a low PB ratio, but it could still be risky. Always look at a company's debt levels before making investment decisions. Remember, the PB ratio is a starting point, not the finish line. Use it alongside other metrics and your own research to make informed investment decisions. Section 7, When to trust your gut and the PB ratio. The PB ratio can be particularly useful in certain situations. For example, it can help you identify undervalued companies after a market downturn. When the market panics, investors often sell off stocks indiscriminately. This can create opportunities to buy solid companies at bargain prices. The PB ratio can also be helpful when comparing companies within the same industry. It can help you identify which companies are trading at a premium and which are trading at a discount. Remember, the PB ratio is a tool. It's up to you to use it wisely. Trust your gut, do your research, and don't be afraid to invest in companies you believe in. Section 8, the bottom line, PB ratio, a piece of the puzzle. The PB ratio is a valuable tool for investors. It helps you understand how the market values a company's assets. However, it's not a magic bullet. Use it in conjunction with other metrics and your own research. Remember, successful investing is about more than just numbers. It's about understanding the businesses you're investing in. It's about having a long-term perspective. And it's about having the courage to stick to your convictions. So go forth and conquer the market. Use the PB ratio to your advantage, and remember, the best investment you can make is in yourself. Keep learning, keep growing, and never stop investing in your financial future.